What percent of the portfolio should be held aside for opportunities? So it's a good question. Um, again, unfortunately, as you can see, the theme today is there's no hard and fast rule. So kind of, there's another kinder way of saying it depends. So there's no hard and fast rule really. However, what you'll notice from Hedgeye and from Keith is moving inventory around and booking gains, even small ones, is a great practice to have to generate, to have dry powder, right? So that's kind of step one. And I'd say that if I've worked with several RIAs over the years, right, and I've seen folks hold anywhere from 1 to 10% cash. Typically, though, that's more so to manage cash needs for clients versus take advantage of opportunities. But even if it's a bit old wall or what have you, right, a similar rule could be put in place within your process to kind of make that happen, right? So if you want to make a rule that it's 10% of the portfolio is there for opportunities, then you can do that. But as I said kind of earlier in the show, is this question hinges on the evaluation of one's process. And if you don't trade regularly or you're not comfortable with moving inventory around, then you'll need to come up with a practice that works within your process. So again, I just really kind of I don't want to kind of spin the question back onto all of you in Hedgeye Nation, but it really bodes, it's really kind of a personal standpoint that you got to get comfortable with. Seeing the moves within the Macro Pro re-rank, which I just walked through from a gold standpoint, provides an inside glimpse, right, to the incremental moves from Keith and that he makes daily. So in my opinion, that portion of the Macro Pro alone is worth its price of admission and allowed me to level up, significantly. It allowed me to level up significantly, just to get better, being more comfortable moving inventory around. That I'm certainly have a longer term investment horizon. That's kind of how I just think about things. But seeing him move that inventory around, and it's not even being more aggressive, it's just being more pragmatic, really, with sort of taking advantage of the moves within the market. So another key piece here to reiterate is never ever violate your rules or position sizing. If you're struggling, or if you need to kind of come up with sort of I guess cash or what have you to kind of take advantage of an opportunity. The gentleman mentioned selling XLP, and I think it was XLU or healthcare. If that violated his minimum sizing rules, then that would not have been an option in my book, right? So again, if it's just taking advantage of them being kind of green on the day, right, and taking it down to the minimum sizing or close to it, then that's fine and dandy, right? But the violation of any rules, it's a recipe for disaster and or FOMO, right? So if you take something down like an XLP below its minimum sizing, and let's just say we have a couple more days here of sort of the index or the general market itself, or certainly just XLP, moving higher, that's a core asset allocation for us. You can kind of be a little pissed at yourself for violating that rule, right? And generating FOMO and thinking that you got to kind of get in faster than you really need to, right? So anyway, but the min, mid, and max are there to define your risk, right? Your risk exposure to that particular security, especially within a certain asset class, right? So, and then when we kind of combine that with what I mentioned at the beginning of the show in terms of volatility adjusting each piece of inventory, that takes that risk management exercise to the next level. So the next level would be kind of taking that, so you're not just defining your mid maxes, you're then kind of volatility adjusting for each security within that same asset class. So just think about it from like Turkey and XLP, right? So you mentioned Turkey, Keith mentioned Turkey's max for him is 1.5%, right? So I don't have his XLP. He hasn't told me that, but I can imagine it's probably about 4-ish%, 4.5% position. So you can kind of tell that he's volatility adjusting, and you can if you pull up the just even the stock chart for Turkey versus an XLP, you can see that the daily percent moves are significantly different between the two of them, right? So the last thing is what I'd say is kind of like the next way of leveling up or taking it to the next, adding an additional layer is then defining your total asset class exposure. So if it's equity, equity exposure or ETF exposure, figure out what that definition might be for total asset class exposure. Same thing with fixed income. I think some of these questions are like, okay, well, if I have 10% max in fixed income, I could have 100 fixed income takers and there's my, and I'd be violating my rules, right? Well, yeah, but like, define that. Is it 40? Is it 60? And I think it really does depend on the quad that we're in and adjusting things via the quad, right? In terms of what works and what doesn't. And certainly the volatility components within those asset classes for those quads is really important. And each quad is going to have, right now we've got higher volatility really across the board. Now I know VIX is down at 19, but you've got move, you've got the move where it's at. You've got VIX, you got RVX, you got FX volatility, right? So if you go across the board, if you review all those macro show slide decks below inside of that volatility section, you're going to see that everything remains remains elevated, and that's likely a key reason why Key's larger position is the dollar, but that's still, isn't that big inside the portfolio. He doesn't have it at max 12%. He's got it, close to kind of a 4 to 5% right now. It might be creeping up to 6 because he hit the button in RTA and what have you. But my point is it stands, right? So it's he's not maxing out at those positions. So I'm really kind of spending some time on that because I've made these mistakes, and like many within Hedgeye Nation, right? We've all kind of made these mistakes, and this show and this conversation is really to try to help alleviate some of those mistakes, or at least walk people through the reasoning behind them as to why we have these processes in place, and to help kind of get everybody to get better. And because at the end of the day, the goal is generating alpha and crushing the old wall. So let's crush the old wall. Let's generate the alpha. Let's risk manage our portfolios and do it on a really, really elite level.